Are you a current home buyer worried about the potential of rising interest rates and how that might affect your affordability, what you can actually purchase? Or maybe you're a little bit more optimistic and think that rising interest rates might actually bring home prices down and give you an opportunity to purchase something. Well, in today's video, we're going to dive into this in a little bit more detail. We're going to talk about what's happened over the last couple of weeks with regards to interest rates. We're going to talk about how that's actually affected affordability. And we're also going to talk about the potential of rising interest rates and it bringing down home prices over the next couple of months and what that might actually mean for you as a home buyer. In addition, we're going to talk about historically what happens when the Fed starts raising the Fed funds rate, what it does to the yield curve, what it does to short-term and long-term interest rates, so that you have a really good idea of what to expect over the next couple of months. In addition to that, we're going to talk about something that I believe is going to actually impact housing a little bit more than I've previously thought. Now, as many of you know, I'm not a housing crash believer. I actually believe the housing market is very strong fundamentally, and I do believe that home prices will likely continue to rise. But I do think the next couple of months, there's going to be some volatility in the housing market, and it might give you as a home buyer a better opportunity to actually get into the housing market if you're still looking to purchase a home. Now, over the last couple of weeks, what we've seen is we've seen interest rates rise nearly 0.75% since the beginning of the year. And this has had a significant impact not only in interest rates, but also on people's monthly mortgage payments. I actually did a survey on my channel last Friday and 3,200 people responded. Now, a good portion of those people weren't actually taking the survey, they just wanted to see the results, but it was split about 50-50 in those that actually answered the poll. And 50% of those people are full steam ahead, and the other 50% have either been priced out of the market because home prices have risen too high or interest rates have affected them in some form or fashion, which means that, the affordability is definitely starting to become more of a problem. And with the rise in interest rates, it's likely going to continue. But I want to talk a minute here historically, what happens when the Fed starts raising the Fed funds rate. Now, a couple of weeks ago, I did a video, which I'll link to in the description below, where we talked about history. We talked about, will history repeat itself? And we went back and started talking about Fed Chairman Arthur Burns. And then we went through all the predecessors since then and showed what happened when the Fed started to hike the Fed funds rate in order to control inflation. And historically, what happened was the Fed would raise the Fed funds rate, interest rates would decline, but at the same time, the stock market would also decline, and a couple of years later, you would have a recession. Well, what we've seen over the last couple of weeks is the idea that the Fed is going to start to raise the Fed funds rate. And they've essentially confirmed it on multiple occasions. And this past week, they came out and said that they're more or less going to start as early as March. And the tapering is going to end. And the stock market, since the beginning of the year, is already dipped about 10%. So you've already seen a decline in the stock market. And you've seen interest rates rise, but the Fed hasn't started to hike the Fed funds rate yet. So the idea is that as they hike that Fed funds rate, you're going to see less volatility in the market, and you're actually going to see interest rates come down. And as we can see from this statement here on the Fed's actual website regarding the overall impact of raising the Fed funds rate target, they actually go on to say if the past is any evidence, the projected increase in the Fed funds rate will successfully raise short-term interest rates but have a limited impact on long-term interest rates. This will imply a reduction in the term premium for bonds and loans. These observations rely on the Fed not letting inflation stray significantly from its annual target. And that's primarily the reason that the Fed has started to raise the Fed funds rate, is to control the crazy inflation out there, right? We've seen inflation numbers as high as 7% recently. And the idea is that the Fed starts raising the Fed funds rate, it's going to bring those inflation numbers down. And, we've had a hard time over the last decade or so trying to get 2% inflation. So once the Fed starts to raise the Fed funds rate and you start to get some of these supply bottlenecks figured out, and it may take some time, 6 months, a year or so, the idea is that inflation is going to decline probably back to somewhere around that 2% target. And it goes on to say here, It is thus likely that despite the continuing rate hikes, the government, firms, and households will all continue to enjoy historically low interest rates on their long-term liabilities, which essentially means 30-year fixed loans are likely going to pull back with regards to interest rates. In addition to that, I want to throw up this graph here, also taken from the Fed St. Louis Fed website, that shows what's happened with regards to the Fed funds rate over time versus the maturity of the 10-year and 1-year notes during that period of time. And you can see as the Fed funds rate is higher, interest rates are lower, and vice versa, which shows that, if this graph repeats historically, as they start to raise that Fed funds rate, you're likely to see a pullback in the 10-year note. And many people out there believe that mortgage rates and the 10-year yield pretty much run hand in hand, as you can see from this graph here. The idea is that as the Fed starts to raise the Fed funds rate, you're likely to see a pullback in interest rates. But for the time being, interest rates have risen, right? We haven't started to hike the Fed funds rate. It's going to take a couple of months for that to actually play out in the economy, in mortgage rates, if it does, come out to be true. So let's talk about what's going to happen here over the next couple of weeks to months with regards to inventory. How does it affect you as a home buyer? How has it already affected affordability? Well, that's what we're going to talk about right now. So over the last couple of weeks, we've seen interest rates rise nearly 0.75%. We've seen interest rates on a 30-year fix go from somewhere around 3% upwards of 3.75%, depending on, credit score, down payment, all of that good stuff. So what I'm going to do here is throw some numbers on the screen that shows you what's happened during the last 3 to 4 weeks with regards to rates and what that means with regards to monthly mortgage payments. Now, before we get into that, I want to take a minute and ask a favor. If you find any value in this content at all, do me a favor, hit that thumbs up, smash it, punch your screen, whatever it takes to get the little thing to light up. I appreciate it. And if you like content like this, want to stay updated on everything real estate related, do me a favor and hit that subscribe button. So as you can see here, 3% at a $350,000 loan just a couple of weeks ago gave you a payment of $1,475.61. That same payment today, $1,620.90. That's a $145 difference per month. The $500,000 payment went from $2,108 to $2,315. That's $207 per month. And $750,000 went from $3,162 to $3,473. So that's $311 per month. So you're looking at nearly $3,700 a year with regards to an increase in just the last 4 weeks. So those people out there that were on the cusp of qualifying might now be reduced in how much they can actually afford to purchase, because that rise in interest rates might push their debt to income ratio too high, and they may no longer be able to qualify for that $750,000 house. Maybe now they're looking at $675,000, and because of that, you're more likely to see less demand out there in the market. At the same time, you're starting to get to that spring selling season, which is typically the hottest market of the year when most people put their homes on the market. And that market tends to come about the second week in February, sometime around Super Bowl. And this year is looking to play out very similar to what we've seen historically. And I think there's a lot of people out there with regards to selling homes. And I personally believe there's a lot of sellers out there that are looking at interest rates, that are looking at the housing market thinking, I need to take advantage of this now so that I don't miss the opportunity. Now, if you're a seller out there that's also a buyer, it's kind of a moot point, right? Because you're selling and you're buying something else doesn't really matter so much. But if you're a seller and you already have a place to go, if you're a seller and you don't need to find something else, or you've already found a rental, or you're moving out of state and already found that home, timing the market is somewhat imperative, right? Because if you wait too long, maybe there's more competition, maybe rates have risen even further, and your demand is no longer there. So there's sellers definitely sitting on the sidelines. I'm having conversations with them myself, people reaching out to me saying, should I pull the trigger now? I'm worried about rising rates. I'm worried about what's going to happen in the spring, missing my opportunity. So because of that, along with rising interest rates, I think you're going to see supply pick up considerably. In addition to that, there's some people that believe because forbearance has recently ended, you're going to see even more homes come to the market. And now, if you've heard me talk about forbearance in the past, I'm not talking about foreclosures because of forbearance, but I'm talking about the idea that forbearance ending and these buyers that haven't had to make a payment for the last couple of months, now they have their new terms with their lender, and now they're no longer actually able to afford the payment that's been proposed by their lender. So they have equity in their property. They're looking at their monthly payment saying, you know what? I'm just going to sell this and take my money and go rent something or try to find something, less expensive. And that's going to add inventory to the market. So you've got demand likely declining because of rising interest rates. You've got sellers wanting to take advantage of the market. For one, because it's the springtime. Secondly, because they're also seeing rising rates and not wanting to miss out on that opportunity. And then in addition to that, you have the potential of those forbearance properties across the nation coming to the market, adding supply. Now, I don't believe this is going to be enough supply to change from a seller's market to a buyer's market. But what I do believe is it's going to give buyers more of an opportunity to find the right house. If you're a buyer and you've been sitting on the sidelines, you might have a choice now, right? You might have options when it comes to finding housing. And because there's going to be more supply out there, more competition out there, sellers, in theory, are likely to be less egregious, right? They're less likely to try to overprice their home and swing for the fences. Now, some will do it, but as more people see more options out there, more choices, they're less likely to way overbid on one property. If there's only one, you're more likely to see higher offers. But if there's several to choose from, you're less likely to see the craziness in the market. And so this rise in rates over the last couple of weeks might actually help cool the housing market down in addition to the other things that I mentioned and give home buyers an opportunity to jump in. Now, for many of those watching this video, you might think that rising rates just started. No, rising rates actually started back in the third quarter of 2020. And what we've seen is rates rise from the lows. They've gone up, they've reached highs, and they've come back down. They've gone up again, they've come back down. And there's kind of this curve, if you will, right? And what we're going to do is throw a graph up here on the screen that shows you, what typically happens with regards to this rise in rates. So you've seen rates rise from the bottom. They've gone up and they've come back down. They've hit that trend line, if you will. They've gone up, come back down, hit that trend line. And as you can see, that trend line is starting to flatten out. It no longer has the steepness that it did. And rates now have reached a new high. You're likely to see those rates pull back down and probably hit that trend line again at some point in the future. And as that trend line flattens out, that means that rates are likely to pull back some. But you can't go into the housing market with those expectations, right? You can't be buying a house with the expectation that you're going to be able to refinance in 3 months or 6 months or a year from now. You have to be comfortable with the payment now. And we've talked about this many times. If you're planning on buying a house in this environment, you need to make sure that you have savings. You need to make sure that you're not stretching yourself. You need to make sure that you have that longer term time horizon. Why? Not because I think the housing market's going to crash, but it allows adjustments in the market, right? We've been on an upward trajectory since 2010, 2011, and we've seen home prices double in many places across the United States. In fact, my house has doubled in value since I purchased it back in 2012. And so at some point, you've got to have a pullback in these prices. Now, again, I don't think this is a crash. I don't actually think the pullback in home prices is coming now, but it's something that you need to be aware of if you're out there looking to purchase a home. So if you're considering buying a house right now, make sure you're getting updated interest rates from your lender, right? If you were pre-qualified a couple of months ago, have that conversation again, see where rates are, see where your payment is, make sure you're still comfortable with that payment. Maybe it has affected your affordability. Maybe it has affected how much you can afford to purchase. And you need to know that so that you're not out making offers on homes that you truly don't want to move forward with, or that the payment may be higher than what you thought it was going to be. So just make sure you're having that conversation. And if you're just getting started in the process and you don't have a lender to have that conversation with, do me a favor, click on the link below. I'll personally refer you to somebody that I know, like, and trust that can guide you through that process, take great care of you. But if you're still watching this and wondering about history and interest rates, do me a favor. Here's a link to the video I mentioned earlier, going through this in more detail. Check it out. Let me know what you think in the comments below. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.